U.S. inflation showed further signs of cooling last month, but of course this was before the recent tariff turmoil that fueled even more uncertainty over the economy and consumer prices. Joining us now to discuss is Sam Chai, VP for Active Fixed Income Portfolio Management with TD Asset Management. Sam, great to have you back on the program.
Pleasure to be here.
Interesting times to get data. I mean, no data can be minute by minute, and it feels this is the way we're living right now by the headlines. But as we get this print, inflation moving in the right direction, what did you make of it all?
So we got some great news today, Greg. The inflation at least is showing more disinflation progress. I know it's a challenging market day, but at least that'll be good news for the Fed. So looking at the details here, the headline inflation has dropped by negative 0.1% month over month, and the core inflation month over month has increased by 0.1%. Both are meaningfully below consensus. And that has drove the core inflation year-over-year number to 2.8%, while it's the first time it's below 3% since 2021. So really tells you we have come a long way on the disinflation path. Just looking a bit more in the subcomponents, so it's a pretty broad disinflation across the different components, but in particular, when you look at core goods and super core services, those have actually posted negative price increases. So very interesting progress there, and possibly driven by partially weak consumer sentiment as well, as evidence in seeing weakness in out-of-town travel, lodging component, as well as in airfares. The question is that, does the good story end here? Because when we look at the derivative market implied pricings on the inflation path going forward, the expectation is that with the current headline inflation at 2.4%, that could potentially rise to above 3.5% by later second half and actually stay there. So that would be a very challenging picture for the Fed to manage, and we'll have to see if we're in this peace time before the tariff storm.
Yeah, if I had a magic wand and we could take tariffs out of the equation, what's happening in markets now, this report standing alone on its own 6 months ago would have been a great report. Sure. Any sign, and then the uncertainty going forward, any signs in this report that perhaps tariffs are starting to play a role? Is it still too early to read that through?
So the good news is that the impact so far from tariff pass-through still seems modest. And if we just firstly review what's the tariff policy that has come into effect. Recall that in March, the U.S. has imported 10% tariff on all Chinese goods imports, additional 10%, and has also implemented tariff on Mexican and Canadian good imports, as well as the steel and aluminum tariff. But it's not until April where the 10% reciprocal tariff versus the rest of the world got implemented, and also obviously the eye-popping 145% tariff on China, and also the auto tariff. So we will see much more pass-through from tariff to inflation prints over the coming months. And our expectation had been that actually the March and April CPI prints can be somewhat benign. Why? Because of two reasons. One, we are seeing some evidence that there is some front-running of tariffs. So core goods inflation, for instance, in January and February are actually stronger than this month. And come to March, when tariff actually come to effect, we may see actually some mean reversion on the core goods pricing just for now. And the second reason being that given so much uncertainty to if the tariff will become in place, the magnitude, and also the duration, there's incentive for importers to basically delay the pass-through somewhat more and gradually pass that through to the end consumers. And hence why we are expecting that core goods price could rise meaningfully, but not until later in Q2.
Now, so much happened just yesterday afternoon.
Of course.
Bond yields were pushing higher. The U.S. 10-year was getting to a level that was making the markets pretty uncomfortable. Did that 90-day pause, bringing us back down to the 10% floor, did this change an outlook for rates or bonds very much? Because obviously there's a huge effect on the equity market.
Oh, absolutely. Yeah. And, well, not as helpful on the bond market as on the equity market. That was very epic move. But there has been some some support to the bond market too. So there is a less pronounced stagflationary narrative now with the rollback partially of the retaliatory tariff. Versus yesterday, the U.S. interest rate has come down somewhat, but I will say that the level of interest rate right now, as evidenced by the bond yield, is still higher versus pre-Liberation Day. That is something very important that we do want to watch and see. As to, like obviously we'll talk about the pass-through from inflation effect. But if we want to talk about our overall outlook on the bond markets right now, I would say that the upside and downside risk to interest rate to be relatively balanced at this point. Our base case continue to be of a 2 to 3 cuts from the Federal Reserve, perhaps like in the coming months. But what I want to point out is that there does seem to be fatter tails at this juncture. So the scenario where the Fed has to keep on hold and deliver no cuts is non-negligible. At the same time, a recessionary cuts of over 5 cuts are also possible. And for us to position for this, we'll have to see from the hard data side which macro scenario and confirms, and then we can see there's maybe more interesting opportunity on the interest rate front.
So you're trying to look at that data and see what trends are being confirmed. What are you looking at specifically going forward? What's going to help guide you?
So trade policy obviously is front and center, but obviously highly uncertain, but something the market is keeping in mind. But not just trade policies, other area of policies, including on the fiscal side, on the deregulation side, on the immigration side, are also super important because they do shape the macro factors very meaningfully. On the economic data front, the narrative is quite clear. The soft data has been very weak. When you look at consumer sentiment, when you look at business intentions, those has also all weakened meaningfully. But the hard data has been good. Recall that last Friday we got a very good non-farm payroll numbers in the U.S. So labor market seems to be still holding up. The question is that over the coming weeks, do we see those hard data confirm or disconfirm the weakness in soft data? That will be very interesting to see. And in particular, if I have to point to a few indicators on the labor market front, initial jobless claims, and also on the PMI side, the labor market survey will be very important to watch. On the inflation front, inflation expectations will be key because the Fed is starting to worry about is the pass-through from tariff persistent or is it transitory? And a key indicator would be the long-term inflation expectations, and that would really determine whether the Fed can provide further easings, even when financial conditions tightened or when labor market cracks.